Hey guys, so today we're going to be talking about the diversification. And if you have heard investment advice anywhere, that's the first thing any investment professional will tell you as the key to having a good investment portfolio. So what that does diversification mean? It simply means dispersing your funds amongst different types of investments to reduce your risk of loss. In other words, don't put all of your eggs in one basket. So now that we know what diversification means, how does it apply in real life? I mean, it sounds great theoretically, but how do you put it into action? Well, you can use different ways to divide or categorize the assets in your portfolio. And then diversification simply means deciding not to put all of your money into one category. So the first type of categorization you can use is the asset type. And as we've discussed before here, if you haven't seen in previous videos, are that there are different types of investments that you can use. You can use stocks, bonds, fixed deposits, you can buy mutual funds, you can buy alternative investments, etc. So all of those are different asset types. So in a diversified portfolio, you may be putting money in all different types of assets. You can say you put 30% in fixed income and 60% in um, equities and then 10% in cash. So that would be a diversified portfolio, which means you have different types of assets. Even though they're not in the same proportion, the proportion will be dependent on what your goals are. But even though they are in different proportions, you have exposure or you have money invested in different types of assets. Another way to diversify your portfolio is if you were to look at it in terms of the industries of the underlying assets in your portfolio. So, say you have some stocks and you buy a stock of a bank, you buy the stock of a telephone company, and then you purchase the stock of a manufacturing company. Those are three different industries. So, even though all of them are stocks, you have different industries that you're exposed to. And why would people do industry diversification? Well, at different points in time, different industries do better than some. So we can look at last year. With all that was going on with coronavirus, airlines suffered. So if you had invested all of your money in airline stock, you'd be left with pretty much pennies at this point, because corona has been a very tough time for the airline industry. But say you had purchased airline stocks as well as supermarket stocks, while your airline stocks would not have been doing well at all, we all know these supermarkets benefited a lot from these lockdowns, right? So diversification across industries is good to protect you against changes in the economics or the way things are at any point in time. And then a third way to diversify your portfolio is geographically. So what that means, we can buy stock in the Caribbean, we can buy stock in the US, we can buy stock in Asia, right? There are investments that are based all over the world. Different companies all over the world issue stocks, they issue bonds, they have banks all over the world with different types of savings products. Yes, there are limitations to what we can invest in based on different regulations, but looking at diversification from a geographical standpoint just means that when you're buying stock, for example, you may not only buy stock from one country, but you can look at which country, how each country is doing, what are the different factors at play that can make one country be performing better than another. So say we bought some investments in the Caribbean and one country had a hurricane, the stocks in that country may not perform as well as the other country that didn't have a hurricane. So in a situation like that, having this diversified your portfolio between different countries will give you less chance of losses. So if you had invested all of your money in that country with the hurricane, you would have been wiped out with it, right? So these are just some ways that you can look at the investments that you already have to see whether or not you are diversified amongst geography, industries, as well as asset types to give you some protection against risk. Now, there is such a thing as being over diversified. If you want to make any gains, you have to take some risk. And if you only put a very, very small amount in something that is performing very well, it limits the amount of money you can actually make from that good performing investment. So even though we want to spread our risk, we do want to put more or a greater proportion of our investment in those securities that we think are strong and that we expect to perform better. So now that we know how to diversify in a practical way, I encourage you to look at your own investments and spread the risk, but also retain the wealth. All right. Till next time, guys. Bye.